And certainly that idea of having that ballast or the kind of hedge, if you will, in place is something, Mike, that you have made a living doing over the last several years here, specifically with regard to those buffer type ETFs that have a more defined outcome that kind of limit the return profile to a certain band on the upside and the downside and somewhere in between. How much more demand have you seen for those types of products, those so-called buffer or defined outcome ETFs over the course of the past few years, certainly since the pandemic?
Well, it's gone meteoric, right? And I think that it goes back to what we just mentioned about what investors are seeing in the marketplace right now. Look, we've got a massive demographic shift happening in this country, and lots of investors are moving, or a great deal of wealth is moving from the accumulation phase to the distribution phase. Now, a lot of those investors still need growth, but they need growth with risk protection. And the defined outcome space, and let's be realistic about it, the buffered space is probably the first wave of structured product strategies, traditional structured product strategies, jumping the fence into the ETF wrapper. And so we'll see the second and third wave of that begin to happen. But what this is allowing investors to do is create individually customized portfolios with a defined risk level. And, it sort of dovetails with the phenomenon that I call performance that's good enough, right? So 30 plus years in this business, most of those years were spent chasing the S&P. Well, there's a type of investor now, and that investor pool is growing, that has a target in mind for their growth as well as their risk. And the ability to customize portfolios and deliver that risk reward ratio that each individual investor is comfortable with is really behind the boom in not only buffered ETFs, but defined outcome space in general, which involves all sorts of different hedging techniques these days.
Mike, those hedging techniques have now evolved again to kind of the next evolution of these buffer or defined outcome ETFs. And those are the uncapped ones. And you're an ETF manager that has kind of been one of the folks out in front of the idea of an uncapped buffer ETF. So for the viewers and listeners out there, you have this kind of idea that you can have a defined downside, right, in this, but you don't have to be limited for the upside gains. And that means a lot more in a market like we're seeing right now, because like you said, we're grinding higher, sequentially making kind of fresh record highs, not in blow-off, fashion, but just kind of like the slow melt-up. What exactly is the demand profile like now for these so-called uncapped buffer ETFs that still give you downside protection, but then let you participate much more so in the upside? And what exactly does that cost an investor?
Well, I think that the understanding that, equity returns are not linear. Typically, they're fairly lumpy. And as we see instances of those non-sequential returns, and we saw it in 2020, we saw it this year, right? If you look at the sort of the flash crash around Liberation Day back in April and what the market's done since. So you see fairly significant gyrations in the market, and understanding what happens during those periods, it's a bit of a behavioral finance approach, but what happens during those periods has started to open the eyes of many investors to the idea that, okay, look, mitigating risk is great. I would like to do that. But we also need a way to harness those big, chunky upward moves. And historically, a lot of these snapbacks happen after significant drawdowns. A way to protect myself just in case there are additional gyrations or drawdowns, and also participate to the extent possible in the upside. And so your question is, what does that cost? And so a lot of our peers in the space work with a capped upside, and you get 1-to-1 of the upside. And for certain investors, that's great. For other investors that are more conscious of what happens in a significant up move, then we offer them a participation rate or an upside capture rate rather than a 1-for-1. What that allows us to do is historically deliver anywhere between 75 and 85% upside capture without a limit. And in years where the market's up significantly, or 12-month periods where the market's up significantly, the difference between capturing that upside or capturing a big chunk of that upside versus being capped out when it comes to long-term compounded returns is hard to ignore. I think investors are wising up to that situation the more they see significant snapbacks following meaningful drawdowns.
And Mike, a final point to you here. As we talk a little bit about the way that these buffer ETFs work, there's been a lot of debate for several years now at this point, maybe 2 or 3 years at the very least, about the back and forth about whether or not these things are suitable or whether or not the costs associated with the higher fee structure for some of these is worth it in the end for investors. From an ETF manager's perspective, we know that, you make your money managing buffered ETFs. But just what exactly do investors and traders need to understand about the performance and risk profile of buffered ETFs vis-a-vis the types of fees being charged versus just, say, a regular S&P 500 ETF?
Yeah, and that debate, I think, has raged for a while, particularly as buffered ETFs started to garner a larger market share. But the reality is these are essentially math-based products. And while I'll say that as a math-based product, they typically will deliver on what they're supposed to deliver on. However, matching expectations with investment objectives is still paramount in this space. And as it is with any investment space, I think the ETF space in particular tends to suffer on occasion from a little bit of ticker soup, right? When you find a segment that works or starts to get crowded, you'll see dozens of variations on that approach. So in the defined outcome or the buffered space, education is key. Matching time horizons, investment objectives, and risk profiles with the actual product or the strategy, I think, is as important as anything when it comes to investor satisfaction. But again, let's not forget that this is a bit of behavioral finance in the sense that investors that are approaching defined outcome, investing in defined outcome, they're looking for a smoother ride. They're looking to go to sleep at night, not have to worry about what the market's going to do first thing in the morning. And there's a value to that. There's a value to assembling these products, making them turnkey in the ETF wrapper, which, depending on your perspective, is probably more investor friendly than some other wrappers available. And having the ability to do all that in ETF for most investors justifies the fee. And I think that's an accurate portrayal of it. If it matches the risk-reward profile and allows an investor to target their particular risk spectrum effectively, then it's typically worth what you're paying for it. Now, there are some outliers to that discussion, of course, but by and large, I think that's the perspective that I stick with.